show today. Always great to have you on. But we're turning our focus on the election trade, and ahead of elections, this special segment that you will be seeing all week on India Market Open will focus on what kind of a strategy you should have when there is so much uncertainty and volatility in the markets. What is the street trying to tell us? And, quell some of those fears out there as well. Dhananjay Sinha is joining us to kick this off. He's co-head of equities and head of research strategy and economics at Systematics Group. Dhananjay, welcome. Very good morning to you and great to have you on the India Market Open.
Good morning, all of you. Yeah.
All right. So now let's start with the core question, really. Do you think that this concern of the election outcome is a bit overplayed? Is that the biggest issue, or are we also talking about the kind of FII selling that we've seen in May, which has factored that sort of nervousness?
I think there are both these factors are important. I think the market has been pricing in. I think since the state elections that happened later last year, there was a kind of a buoyancy that had erupted after that, in anticipation that you will have a something majority in the next election for the BJP in its third government. So I think that has been priced in. And secondly, I would say also since December there was an early pivot that the Fed has actually inculcated in the market. So market was expecting about 6 or 8 cuts this year. I think that has been rolled back with the inflation momentum moving up, averaging about 30 to 40 basis point in the recent months. So that essentially means that somewhere around mid of this year, you might actually see US the core inflation starting to move up, and more so with the commodity prices rising. So both these things are playing their roles, and hence there has been a sort of a initially, there was a buoyancy with respect to FII flows, both with respect to equities and bonds. But we have seen that moderating, and there has been an outflow recently. So I think if the numbers for the NDA, is lower, let's say, let's say about 300 seats or thereabout.
Yeah.
So I mean that's what people are increasingly talking about, and you have the tone of the Fed actually changing in somewhere around mid of this year, somewhere around May, June. I think there can be sort of volatility in the market, and the market has been somewhat overvalued.
Dhananjay, but just explain to me, and the point that you made. So if the NDA tally is 300 instead of 400, although in a conversation with us, the Prime Minister just last evening has reiterated 400. But okay, if the market is accounting for 300, I'm trying to understand why that is necessarily a valid reason for this kind of panic. What difference does it make to the ability of any government to run a country or to govern when you need 273?
Yeah.
So, is this more a case of finding an excuse or a reason to sell off after or book profits in a market that has run up massively since last December, as you mentioned?
Yeah, I think you're right, actually, but the fundamental reason is also that there is a certain amount of policy slant that the government had been running, the Modi government had been running, which has been favorable to corporate profits or the fiscal prudence that they've been talking about. They've been talking about a lot of investments on infrastructure, etc. So I think there will be uncertainty around those factors. I mean, our analysis shows that if you look at the Nifty 50 earnings over pre-COVID levels, there is a compounded growth of profits or EPS of roughly about 20%. I mean, if you look at US S&P 500, that will be about 8 or 9%. So essentially, what has happened is that post-COVID, the buoyancy in the corporate profit has been pretty good, and that has actually translated into a good amount of flow, especially in the local markets. The retail participation has been good, especially with respect to the mutual fund flows, which has been roughly in the region of 22 to 25,000 crores each year. each month. So that has actually translated into a significant buoyancy in the mid and small cap space. So you know that when the sentiment turns and some of these factors change, the volatility can be very large, and especially since the illiquidity has been under.
We've lost that feed over there. But the point that Dhananjay was making, that you have seen this come in the wake of a market that has run up. The primary concern in the market still seems to be, an NDA not hitting a 400, but effectively a 300 or 320 makes no difference in the ability to actually run. Dhananjay, we've got you back. Let me just, cut to the chase and really what our viewers would want to know right now. All right, so you're looking at a period of volatility. The India VIX has gone up substantially. So what do you do? What do you do? Is this the time to, make a bet and really sit back and take advantage of some of the prices that are available in the market right now? I mean, you have a Tata Motors down 6.5%. Is this the time to go shopping or stay on the sidelines?
So I think at this juncture between so I think we'll need to look for the outcome of this event. So that's one thing. But generally, I would say that between the value and growth dichotomy that the market generally trades on. So right now we'll focus more on value stocks, and these will be large companies who have existing businesses and are available at at good value, rather than expecting continuous growth for small and mid cap space in particular. So that's the broad strategy, and I would say that I would look for election related volatility or global flows related volatility to sort of create good value before sort of jumping in. So I think at this juncture, I would rather look for the right list of stocks that I would want to buy and look for right valuations. And I think there can be a good opportunity to make money.
Dhananjay, so if you're an investor, what is the portfolio advice you have for investors at this stage? Would you recommend taking a little bit of a cash call? Would you recommend doubling down if the market, say, correct 5 to 8% from here on? Or simply take profits and stay on the sidelines and wait for a re-entry? So what I want to essentially understand is taking profits and a cash call. Is that advisable, or you'd stay 100% invested?
No, I am not 100% invested. So basically I have roughly about 5% as bond portfolio. So I have the 10-year yield at 740 is where I have invested in. So there is a certain amount of buoyancy that can be earned. So I think the bonds can actually do well in the near term. Broadly, I would say it's kind of a light in terms of beta. It's better to be more closer to the index rather than try to look at very high beta in the current market. So that is one thing. I would rather be with liquid stocks and sectors wherein the impact of the events can be much lesser. There are certain value and structural growth indicators or sectors that we are looking at. One particular sector that I look at is the auto space. We are looking at a sustained recovery in the two-wheeler space, for instance. So that I think there is a 2-3 years of runway that we are looking at there. Likewise in agriculture, equipment, etc. So those are specific sectors and stocks that we are looking at.
Dhananjay, I think two sectors that for the last 4-5 weeks they've taken a little bit of a break right now has been defense and railway. Actually, no, pardon me, it's not the last 4-5 weeks, it's the last 1 year actually. A lot more escalated in terms of the buying we saw in the period of Feb and March. And it was being called the election play, right? Railway stocks and then a Jupiter wagon is one that you recommend as well. And so is defense. We've seen some of those earnings. They're impressive to say the least. Do you feel or recommend that, do you have any recommendations in the defense space or the railway space that one could still accumulate at this stage despite those valuations?
No, I think defense has been there in our portfolio for a long time, and we're still overweight on that. So a couple of stocks that we have are BL and HAL. So those guys are doing very well. I think the whole story is, I think this whole geopolitical story that has been there, and the way government's been investing in defense is something that will sustain irrespective of this government or the next government, whosoever comes. I think that sustainability will be there. I think with respect to infrastructure, I would say that why Jupiter Vacant has been doing well is because the government has been scaling up, spending on the cargo area rather than passenger movement. So I think the cargo space is actually doing well. There is an expansion that is there. I think there is a switch between the road freight and the railway freight in favor of railways, because the relative cost and freight rates are cheaper with respect to railways. So I think that is a kind of a switch that's been happening. So I think the demand out there might actually still be there. So I think that is there. I think more concerning for me would be more investments in roads and all. There can be a certain amount of slackness that might happen, because you look at the budget, the interim budget, the growth in the allocation for railways, for roads has been fairly modest. I think 4 or 5%. So I think I'm bothered more on the road side, and that also is reflected on the fact that the MHCV volume growth has started to decline, and it implies that the utilization of roads have been somewhat lesser. So that would also that would also have an implication for cement sector. So I think some of the infrastructure and defense space, we need to be selective, and we need to know which sectors might actually sustain sort of a structural trajectory compared to let's say roads, where there might be might be viability issues coming up going forward.
Right. Thank you, Dhananjay. Great talking to you this morning.
Yeah.
We'll hopefully see you soon as well.